Now, welcome to this presentation on leverage ratios. Leverage ratios are those which measure a company's inherent financial risk by quantifying the reliance on debt to fund the asset. The following areas will be covered in this presentation. Financial leverage, it is the assets by equity capital, the last ratio of the Dupont analysis. Amount of debt in capital structure, the benefits of having debt and factors limiting the debt in the capital structure. Widely used leverage ratios, debt to equity ratios, debt to asset ratios, debt to total capitalization, assets to equity. These are some of the widely used leverage ratios. Degree of financial leverage, concepts and explanations, mathematical calculation and uses. Degree of total leverage, concept and explanation, mathematical calculation and the uses. Empirical analysis of the financial leverage, uses of regression to evaluate some financial metrics as predictor variables in predicting the financial leverage of the companies. I am Aninda Datta, the presenter. The asset to equity ratio is the last ratio of Dupont analysis, as it indicates how much of the total assets are funded by equity. So a higher multiple indicates higher debt level. If the return on invested capital, net income after tax by total capital, is more than the net cost of debt after income tax deduction, then it is beneficial to a company to add more debt. The excess of return on invested capital over the net interest cost accrues to equity shareholders and increases the return on equity. But what stops the companies from working with bare minimum equity capital and high debt level? As taking higher debt causes the fixed interest payment obligations and repayment obligations to rise significantly, causing risk of default in case of fall in sales or in operating profits. Thus, even though raising the proportion of debt in the capital structure increases the return on equity, the companies need to balance the financial risk and return on equity gain to arrive at an acceptable level of debt to equity ratio. Also, the cost of debt increases with increase in financial risk level. So a company has to keep the debt to equity level within reasonable level. In many cases, the company may not have sufficient assets to mortgage to raise more debt. Now, the three balance sheet items, debt, equity, debt, assets, and market capitalization, could be juggled around to arrive at many leverage ratios. Now, debt to asset ratio, that is total debt divided by total asset. Higher multiple indicates higher proportion of debt in the capital structure. Debt to equity ratio, that is total debt by total equity. This ratio could be calculated using balance sheet figures or total market value of debt and equity. Now, total assets to total equity, this is the Dupont ratio. Higher the multiplier, higher is the debt in the capital structure. Now, net debt to total capitalization. The numerator is total debt minus cash. The denominator is total debt plus equity capital plus the preference capital. Degree of financial leverage. This shows the sensitivity of net income to change in EBIT. Now, degree of total leverage. This shows the change in net income for change in the sales. The degree of financial leverage is another widely used leverage ratio, measures the sensitivity of companies' net profit to fluctuations in the operating profit caused by presence of debt in the capital structure. Degree of financial leverage is given by the formula percentage change in net income by percentage change in EBIT. Degree of financial leverage is also given by this formula EBIT by EBIT. Both the formulas would give the same result. Now, this table shows the calculation of degree of financial leverage for a company where the COGS is 50%. So EBIT by EBIT by EBIT 400 by 200 gives the degree of financial leverage equal to 2. Now, let's calculate the degree of financial leverage by the second formula. Here, two different columns are given for two different sales figure. Here, the first one is a higher sales number by 50%. So here we are calculating by percentage change in net income by percentage change in EBIT. So percentage change in net income, that is the net profit, is 125%, and the percentage change in EBIT is 63%. So dividing the numerator of 125% by the denominator of 63% gives the result of 2, the same as this one. As could be seen, the higher is the absolute value of interest expense, higher is the degree of financial leverage. That is more is the fluctuation in net profit for change in the operating profit. Thus, a company could increase financial leverage by increasing debt in its capital structure. The degree of total leverage is the sensitivity of net income to change in the unit sales. It is degree of operating leverage into degree of financial leverage. Degree of total leverage equal to percentage change in EBIT by percentage change in sales into percentage change in net profit by percentage change in EBIT, equal to percentage change in net profit divided by percentage change into sales. Now this table shows the calculation of both operating leverage and financial leverage, and from them we can calculate the total leverage. The degree of operating leverage is 1.43 here. That is 14 by 10%. The degree of financial leverage is 2.33. So that is the change in EBIT by change in EBIT. That is 33% divided by 14% equal to 2.33. So if we multiply the two, it gives the degree of total leverage equal to 3.33. So the change in percentage change in net profit is 33% and the percentage change in sales is 10%. So this divided by this is equal to 3.33. So multiplying operating leverage into financial leverage, that is 1.43 into 2.33 gives 3.33, and the net profit is changing 33% of the 10%. As sales increases by 10%, the net profit increases by 33%. The net profit increases the total leverage times the increase in sales, that is 3.33. The companies aim to optimize the debt to equity ratio towards twin objectives of minimizing the cost of capital and maximizing the value of the firm. Now, what are the factors driving the financial leverage decisions of the firms? Some empirical studies have been conducted to identify the factors driving the financial leverage decisions. Most studies used linear regression methods wherein the financial leverage was predicted variable, and a wide range of predictor variables were used, like liquidity position given by the current ratio and quick ratio, the financial performance factors like the return on asset, tangibility of assets, and return on equity capital, and return on capital employed. One research carried out on the Indian companies, on listed Indian companies, is available in the attached URL. Anybody wants to view the entire research report can go to this URL. The result shows current ratio and quick ratio have insignificant impact on the financial leverage, as coefficient the beta are less than 0.1. Return on equity capital has a strong negative impact on the financial leverage. That is the coefficient of minus 0.19 and p-value of less than 0.02. Return on capital employed has strong positive impact on financial leverage. It is coefficient of 0.24, positive 0.24, and the p-value of less than 0.01. The p-value indicates the probability of that slope being 0. That is, there is no probability of, from the observed data points, the probability of having no relationship between the predicted variable and the predicted variable. However, the adjusted R-square has a value of just 0.2, thus showing low predictive power of the financial factors considered in the regression analysis. Now, what is the impact of tweaking accounting figures on Dupont analysis? The Dupont return on equity is given by the multiplication of net profit by revenue into revenue divided by assets into assets by equity capital. That is the multiplication of net profit margin and asset turnover and the leverage factor. As we covered the entire Dupont ratio analysis, what happens if a company books revenue expense as capital expense in its financial statements? That is, it understates revenue expense and overstates the asset values. The net profit for that financial year would be overstated, but the reserves and surplus and assets too would be overstated permanently. Consequently, capital and reserves is overstated permanently. As equity capital is overstated permanently, so return on equity would be understated for every subsequent year. As a company strives to minimize the cost of capital through optimum leverage ratio, so we need to calculate the total capital cost to figure out how to minimize the same. The total capital cost comprises cost of debt and cost of equity. In the next video, we'll evaluate the methodology of capital cost calculation and how degree of leverage impacts the cost of debt and cost of equity. So this concludes this presentation. Thanks for watching.